Hey, everybody, welcome to our latest episode of X Factor, where we engage with PE-backed executives to try to pick their brain about a value creation topic that can benefit the masses. And we're so excited today to get into pricing strategies with a great guest, Brian Lanier, who's the CFO of Fishbowl, which is backed by Diversis. So, Brian, thanks so much for joining us. Welcome.
Thank you. Good to be here.
Good deal. So just give us a quick overview of your background and how you arrived at CFO of a PE-backed company, if you could.
Yeah, no problem. So I'm a recovering CPA. I usually start with that. So I started off after graduating from BYU. I started off at Ernst & Young in Las Vegas. Did that for about 4 years, and then for the last probably about 15 years, I've been CFOs of technology companies mostly. So it's kind of an accidental, happy accident. I ended up working for companies that every time I try to land and plan on being somewhere for a while, I end up being somewhere that does a lot of M&A transactions and ends up selling. So I've done this multiple times. So I started off with a company called Solera. So Solera acquired the company I was working for at the time, SRS. We did automotive repair technology. I went from there to some healthcare technology space, National MedTrans. I was only there for about 2 months actually before we went and sold that company. Went to another healthcare technology company as a CFO called Central Logic. Sold that company, and then I'm from Las Vegas originally. Was too cold to move to Minnesota where the company was heading, so that's how I ended up at PDQ. I had not even been there for a year before the market was hot at the time to sell PDQ, and that's how I ended up at Fishbowl. So I kind of accidentally fell into a nice little career of landing at multiple PE-backed companies that needed to be kind of rebuilt or turned around and then sold. And that's how I ended up here.
That's quite the run of exits. That it's tough to go one for one, let alone for four for four. So good for you, and let's make it five in a row here. So before we get into pricing, just your quick thoughts on private equity and kind of what attracted you and what keeps you in that asset class.
Yeah, so really I kind of found a bit of a niche where I like getting my fingerprints on things, right? So it's the growth stage company that I keep landing at. So a lot of times I'll land somewhere where I'm building their first forecast model. I'm putting in controls for the first time, in a situation where there's some sort of a turnaround. So I like the strategy of finding the levers and trying to find out, taking a company that has really good potential and a really solid foundation and finding out how to take that and really lever it. So every time you go into a new company, there's obviously waste that you're going to find that you're going to want to fix, but there's also a strategic element of finding out. So with the pricing is always a big one. You start off with if you're priced right, then if you're paid right, so the margins line up and the whole company's right sized. And there's always this element of almost kind of like solving a puzzle and fixing things that really appeals to me.
Yep, outstanding. So as we get into pricing here, maybe I'll just make a couple comments about what I've seen over the last decade of doing recruitment work for PE-backed companies, and then we'll get into your expertise. So for those that are in a private equity-backed company today, you already know this, and for those listeners that are anxious to get into private equity, pricing is an incredibly important lever for PE-backed companies, particularly when it's a first-time institutionally backed business where pricing strategies that may not really been explored. There's a lot of reasons why pricing isn't pulled as a lever. There's psychology, there's fear of loss of customer, there's relationship with money issues. But one thing that private equity does really well is takes the emotion out of it and gets into a more analytical approach. Because if we can raise those prices, 100% of that price increase drops to EBITDA. And although there will be some churn, usually there's a net positive value creation outcome as a result. So this is a really important topic for everybody, and we're happy to kind of get into it with you. So just kind of take us through at a high level, what are some of the hallmarks of a well thought out pricing strategy? What are the usual suspect elements?
Yeah. So and maybe real quick before I jump into that, I'll add one extra thing to what you said, which is I've never landed at a new company or even acquired a business that has not needed to have some pricing work done. I've talked to some of the old founders before they sold to private equity, and it kind of landed in the pricing, kind of like, well, I don't know, it felt right, or that's what we could sell it at. Or sometimes even if there's more thought going into it, I've been somewhere where there's, 8 years without a price increase. And so maybe the one point the pricing was good, but that was 8 years ago. And now it's time for an increase. And so there's been opportunity everywhere I've gone, right? And so when I landed a company, what I usually start to look at, it all starts with the value proposition. Your your company, you're assuming if it's private equity owned, it's growth stage, or it's got some sort of a solid foundation. It's in business for a reason, right? Customers see some value in what you do. So the first thing that you do is you figure out what that value prop is. When at all possible, you try to put some numbers to it. If there's any math behind it, it makes the whole thing easier. But it all starts with what value are your customers getting out of your product? And the easiest case is if your product helps them boost their revenue, that's the easiest lever to pull. Sometimes there's cost savings. Sometimes there's some sort of compliance value where if they're not compliant, the risk there is significant to the customer. But in every aspect, you've got a solid business with a customer base that's paying you for a reason. It starts with that. So the first element that whenever I look at the pricing, I start with that value prop, and then I try to create what I call a credible no-brainer. So the credible
And Brian,
no-brainer.
on that value prop, let me just jump in for a minute.
Mhm.
That's probably a helpful exercise for the senior team to kind of step back from the day to day and almost reconnect with why are we even in business in the first place? What are we really doing to add value to customers and really put yourself in a benefit versus feature mindset?
Absolutely. Um, and this will all line up together. If we do this right, this will boost your sales because this will then align your sales with the same value prop pricing is based off of. So that's I'll get to that in a second. So the first thing, right, the credible no-brainer. That's where if I were to tell you for every dollar you pay me, I could put $4 back in your pocket, you'd be insane not to do business with me, right? Or if I said $10, even better. But
Hey,
that's kind of my sweet spot.
hey,
Between. Yeah.
Brian, looks like darn it, it looks like I got the old classic unstable internet connection.
Oh,
Brianna will fix this for us. I'm just going to re-ask that question about the benefit, kind of stepping back, and then we'll kind of go from there. And if this
perfect.
persists again, I guess I'll just throw in the towel and we'll reschedule to when the internet's behaving better. But let's keep going.
Yep, that works.
Yeah, so Brian, let me jump in if I could. So that exercise in and of itself, stepping back as a management team and asking what are we really doing for customers is probably useful above and beyond pricing, helping everybody stay back in touch with, the actual benefits of why the company's in business as opposed to being too hung up on features.
Absolutely. In fact, you'll notice that if you do that, that'll just tie pricing to the whole business in general. That's pricing becomes one component of an aligned strategy. And it needs to start with the value prop. What are you in business for? And so that's critical in this exercise. If you start with that value prop and then you can quantify what value your customers are getting, that's where you get into the credible no-brainer, right? So if I were to tell you that for every dollar you paid me, I could put $4 more in your pocket, you'd be insane not to do business with me, right? You couldn't pay me enough money because you know that I'd return 4x whatever you pay me. If I said 10x, even better. And that's kind of my sweet spot, that range right there, the 4x to 10x. That's where I call it credible because if it's below four, if I tell you for every dollar you pay me, I'll give you back $1.50. It sounds good, but it might not be worth your time. So it's not a no-brainer. If it gets over 10, if I tell you I'd give you 100x, then you'd either think I'm crazy or a fraudster. And so it's no longer credible. So I kind of try to find that sweet spot of delivering the value to the customer that's the credible no-brainer. And then the second element I usually try to go for the pricing is alignment. And this goes back to what you're saying, right? The value prop. So when you do this well, then whatever is good for the customer is good for the company and is also good for your salespeople. You're all rowing in the same direction and everyone's getting value out at the same time. So
And when you dig in on that front, what are some examples of, I guess every business probably thinks they're in touch with the benefits they provide to customers, but what are some of the usual suspect missing dot connects that you've discovered when you go through this exercise?
So I'll give you an example from when I was at Central Logic, right? So the pricing there was probably the biggest price increase I've done at any company I've been to. But as I dug into the math, I found out they were sitting on an incredible value prop. They didn't realize what they had. Every time you signed up a customer, the customer would would have an incredible revenue growth that was predictable. You could take a look at the number or the volume of the transactions they're running through their system, and you could predict a 10% growth in their revenue just by signing up for their product. And it was such an incredible value prop that now we wanted to align that we'd say, by signing up with us, you'll get this predictable revenue growth. And so we took a 10% kind of price or subscription to land around 10% of that. And then we aligned our commissions around everything else so that really everybody's happy and everyone's benefiting from that.
Yep. Yeah, no doubt. Okay, good deal. So, who on the team, obviously you're coming at it from a CFO angle, and I'm sure it's a broad-based effort, but who are some of the most important stakeholders to get this thing right?
And that's a great question. You want to make sure you've got the right people at the table. And a lot of times it depends on the size of the company you're at. So smaller companies, we haven't had much in the product or product marketing arena. Bigger companies, you'll have resources that this is more of aligned with their job and what they do, right? So if you get the product marketing people, a lot of times they'll take the lead on a lot of this. When you have private equity backed companies, private equity a lot of times will even want to be involved. They'll have a lot of times some of these consultants who charge a pretty penny, but they provide some good resources and some good market research that helps get you started. So a lot of times what I make sure is there, if you've got someone on the product team or like a product marketing type person who's got their finger on the pulse of the research for the market and competitors, a lot of times starts with them. You want to make sure they're at the table. When they're not there, a lot of times I've kind of taken the lead on this. I always want to make sure I have sales and marketing at the table, because a lot of times you've got your salespeople who also have a good feel for competitors and market and price points they can sell it at. The consultants who does the market research, a lot of times they'll have really good broad-based experience of seeing other companies in similar circumstances. So they bring good insight to the table, along with your private equity sponsors. CEO definitely needs to be at the table, because this is one of the core initiatives that is going to determine the strategy and the direction of your company, right? So it's a big decision. The CEO has to be heavily involved.
Mhm.
And I usually start there.
On the consultant front, there's been a real rise in the number of pricing consultancies out there, and we see their pricing structures all over the map, and it's usually not cheap. What advice do you have for your typical Portco exec team around how to think about using a third-party pricing consultant, and at what level, and what should they brace themselves from a budget standpoint?
So that's a great point. I've paid up to about $500,000 for a consulting job for pricing before, so they are really pricey. I think, in my opinion, they're more valuable in industries where it's harder to get the information. If it's easy to get your competitors' pricing, excuse me, if it's easier to get your competitors' pricing, and if it's easier to get that intel on your own, someone in your product marketing department can do that on their own. It's usually not as valuable. But I've worked for industries where you have a lot of private companies and it's hard to figure out what the pricing even is. And so they get on the phone and they make phone calls to customers, prospective clients, competitors, and they can get that information that's hard to get to. And that's where that's really valuable. The things to look out for these consultants is, a lot of times what they do is they kind of start and end with, and they've got some good math on price points and elasticity, and they try to triangulate about where you should land. And that's very helpful too. That gives you a good sniff test of where you're landing, if it seems to be in the right spot. But a lot of times the caution is they kind of start and end with marketing research. They don't go as far as your value prop and this other alignment with the rest of your business. They just like to say, well, your main competitor's landing here, so you guys want to kind of land right about here, right? And so that's an important component, but that's just a piece of it. A lot of times when we've had these consultants come up with their pricing, you want to be careful that it doesn't come now into the business, and now you've got someone on the sales team saying, well, the competitor pays this, so we can't go above here, and they're kind of scared to go above it. If you believe in your product, that you have a premium offering, that you've got better features and more value add to your customers, and for all other reasons, you shouldn't be afraid to charge more.
Mhm. Is there any conflict of interest to be wary of with some of these consultants, where if they're incentivized to drive the greatest price increase possible, are they at risk of guiding too aggressively?
That's actually a great question. I've had a little bit of the opposite experience. So I usually stay away from those type of arrangements.
Okay.
I don't want to give a piece of all the upside. We'd be doing it with or without them. We're just trying to get a data point, right? So I usually try to coordinate a flat fee with them. So they come in, they do the work, they do provide the consulting, but we keep that upside for us. And what I've normally seen, in fact, is they, in those circumstances, maybe just because of the pricing arrangement, they've been a little bit cautious and kind of held us back from being too aggressive. So, but I could definitely see where if they get a piece of the upside, they would be a little bit more aggressive.
Mhm. Who on the team of stakeholders is going to be sort of most worried about price increases?
Great question. I've noticed that usually the person who's most hesitant about the price increases is going to be on the sales team. The most successful price increases I've done have been when the sales leaders are on board and they believe in it and they're excited about it because they know you're underpriced and they know they can get more revenue out of it. But I've seen most often they're worried about the price increase. They might miss some sales quotas. The unit growth is going to slow down, and they're kind of more. He's got some of that FUD, right? They're afraid that they're going to go in there and start missing numbers, and so most of the time I've seen buy-in from everyone else more readily available than the sales team.
Mhm. And what's a reasonable amount of churn? So you're going to raise prices, you know that you're not going to retain 100% of all customers, but the net growth will make a little bit of churn worthwhile. How do you think about those expectations, and how do you help the sales team get comfortable?
So this is where it gets a little bit fun, right? This is where a lot of the strategy comes in because that's the right question to ask. And most of the time, you're hesitant to increase your churn. Anytime you do price increases, or I've done a lot of times where you go from a perpetual model and I'm now converting the company to a subscription model, you're always going to see an increase in churn, right? So the question is going to be, you do some math and you find out what your lift is. Like you said, price increase all goes to the bottom line. So it's a really powerful lever, but you're going to want to try to balance that with how much churn are you willing to accept and how aggressive you're going to be. And so that depends on a couple things. One thing, a lot of times PE backed, is what's the hold period? So if you're early in the hold period, and this is a good time to do it, it's kind of early on so that you can get the momentum towards the end of the hold period. But if you're towards the beginning of the period, maybe you can accept a little bit more churn because by the time you get that churn kind of worked out, the churn will rebound and the people who are new customers coming into new pricing, they have no problem with it. They're fine. The price increases are going to be harder on your existing customers. They're going to see the increase, maybe not the value wasn't sold the first time. And so it's going to be harder on them. But once you kind of work through that spike and churn up front, it'll rebound and you'll see the business level out to some metrics that you're more comfortable with towards the end. And so maybe towards the beginning, you're more willing to accept a little bit more churn.
Mhm.
If you're towards the end of the hold period, or you think that you might have an exit sometime during this period, you're going to be a little more conservative because let's say a 10% lift is still good, but you don't want to have any red flags from a churn percentage over 20%, like the big spike that's going to raise red flags. The third thing that you want to keep in mind, I've been at a couple of companies where you really just don't have a cash position that allows you much flexibility. So you're trying to toe that line of doing the price increase without too much churn, so that you can't lose some of that incoming cash because you really can't afford to have a dip in cash before the rebound.
Mhm.
So a lot of this stuff is what you want to try to find the right balance of the right uplift of the risk you're willing to assume, depending on some of those factors.
And I would suspect there's some risk in being priced too low, that customers are drawing conclusions about quality and competitive kind of worthiness. And if you're unknowingly priced too low, they might ascribe lower levels of quality to your service, perhaps.
Absolutely. I've seen that a few times. So, and that's going to be, again, you're going to want to have a good partnership with your whoever's in charge of your leader of your sales team, right? So if you have a sales leader who's a little bit nervous to charge more, who's not willing, who doesn't really believe in the product and think we have a premium offering, they're going to want to try to compete in price. You're always going to be battling that race to the bottom, right? Then you're going to be, instead of selling on value, it's going to be hard to align with the new pricing because they're, instead of value selling, they're discount selling or feature selling and trying to manage that, which then you lose the alignment, right? The second principle I mentioned. Um, you lose, there's a whole lever if you go from the sales process from the beginning, you're pitching this value prop, the pricing aligns with it, and all your marketing materials all align, then you get a big boost out of this. And I've seen sales double through big price increase and sells double at the same time. If you don't have that alignment and they're still kind of discount pricing, they don't believe in the value they're trying to sell, and they're still nervous the competitor could undercut you, then you lose a lot of that momentum. So that's why a big reason for having it, I kind of lost this maybe out of this part out. Sorry, I lost my train of thought there, um, but going back into the sales leaders, but if they do believe in it and they do are willing to charge more, and that reinforces that alignment actually reinforces the value prop that you're selling to your customers. They believe that you're going to give them a bigger lift than the competitor, and they'd be willing to pay for it. And you know what? If they pay for it and they get a 4x return, they'd be more than willing to pay for it because they believe they'll get a better lift from you than a competitor.
Mm-hmm.
And in fact, you probably remember from way back in business school, there was a Ben and Jerry's case study. If you remember hearing that, how they first, when they came out, they were a low priced option and they really couldn't get sales to go. And then they redid their pricing and all of a sudden they came in at a premium, and all of a sudden the perception of their product flipped to where they were viewed as a premium product and their sales took off.
Mm-hmm.
So all part of that alignment, if you believe in your product, if you're a premium company, you shouldn't be afraid to charge it, because it actually reinforces and you get a bit of a flywheel effect where people will believe that additional pricing premium reinforces the value that you add.
Mm-hmm. From a lot of the interviews I conduct, it seems like too often pricing increases are a little bit more generic, and a team will have decided arbitrarily to raise 5 or 10%, or maybe that was pushed down from the private equity firm. How customized does a pricing strategy get if you're talking about multiple service lines, multiple products, multiple offerings, in terms of where those dials are turned across that mix of products and services?
Yeah, and that's a great question again. Here's the next part where this gets fun. So if you're really doing this, you're taking a look at your whole pricing strategy, right? You're aligning everything. It's supposed to align with the value prop. And then you can then leverage that for how you can discount or how you can incentivize. If they believe in that value prop, then the only reason they wouldn't do business with you is if they don't believe in it. So then you can give them incentives or guarantees, or you can start playing with different levers like that. But then this also builds into what you're saying right there, which is if they had it pricing pretty close to right the first time, maybe you can just do like a 10% increase. You were close, just tweak it and you're fine. But a lot of times I've seen there's a lot bigger discussion, which is, do we bundle it? Do we sell these as one-off products where we can land and expand? And once you figure out the value prop and how your customers come into the ecosystem and into the company, then you can figure out the best approach. And now there's a whole strategy behind it. Maybe you just lead with a big bundle that has all your services. Maybe it's really easy to start with kind of like a foot in the door intro, and then you've got an account management team that can then work with them and get them add-ons and different products. So it all kind of comes down to, again, like, what's the best approach based on what the value prop is and based on your customer profile. You have to understand this now aligns with your ICP, right? Your ideal customer profile is going to either be like an enterprise business or a small medium business, and that's going to impact and the industries that you're in, that's going to impact how you like to get in there, and so you can boost sales, maximize share of wallet, and all these other things become a part of the strategy. It's not just a price point, but it's how you price and package the whole thing that becomes part of the fun.
How does the pricing strategy play out over the course of a 12-month calendar, knowing that there's some broader strategic discussions that are happening perhaps on an annualized basis, but then there's also the renewal strategy? I know as a small business myself, we subscribe to our share of SaaS products, and every time there's a renewal, here comes a larger than expected price increase, and we fight about it. We settle on something that we think we can live with. But how do those two dynamics interplay as the year unfolds?
So that's a great question too. So now you go to getting more into long term. Right now, your foot's in the door. You assume you've landed on the right price point, but how do you keep that revenue stream growing going forward long term, and then keep the customer happy long term, so that you can again find that balance with customer retention and then revenue growth, right? So great way to think about it. The couple pointers that I found have been helpful is, the first one is just upfront, you be honest with the price increases. Either in your agreement, your standard EULA will have a price increase built into it, which so they know to expect it. Most of the time I like to lead with an auto renewal, which means they're going to just stay on board unless they're unhappy, and then they'll say actively choose to cancel. I've landed a couple companies where they have an active renewal cycle. You're not auto renewing, but a customer every year has to decide if they want to become a customer again. And if they don't actively sign up again, then they leave as a customer. And your churn rates are usually really high in those scenarios. So it's kind of like Netflix, right? That if I had to sign up for Netflix every month, if I wanted to continue, I would get annoyed at that and eventually just quit. But
Mhm.
as long as I'm happy, if I just stay, then I like to have those arrangements, right? That helps your churn, helps the customer's experience be a much better experience, frankly. And if there are just price increases built in as an expectation, that helps that. But then the second thing is you'll have price adjustments every once in a while. So not everyone signs up for an auto renewal, especially like bigger government contracts or larger companies. So let's say you have a 3-year agreement, right? And they won't, you can't get auto renewals in place in your industry for some reason. Then in that case, you've got another negotiation coming up on board, and that's where the additional value comes into play, right? You've got the argument for the annual price increases. Maybe there's inflation that everyone understands, and that's just a part of it. But if you want to do something beyond that, you have to have a solid argument of saying, hey, look, we've added these additional features, or there's something else that either you can either just upsell along the way where you're adding additional licenses or new products. But anything beyond that, really, the customer is going to get tired of feeling like they're being gouged every renewal period. If you can't point to something better that the software can do now that it wasn't doing when you signed up before.
Mhm. Yeah, so that customer education is essential, especially the more you're dealing with a price increase that is above and beyond what someone might anticipate from an inflationary or kind of normalized market setting increase.
Exactly.
Yeah, interesting. What are the watch outs when you've seen either pricing strategies that you've worked on not go as well as they could have and they were learning environments, or you followed something that wasn't great and you had to kind of fix it up? What are the watch outs for a pricing mistake?
So I point to a couple. The first one will go to my third principle, right? So the third thing that I try to do when I do pricing is keep it simple. Sometimes you'll notice that, especially with private equity, you get some guys who are really smart and good at spreadsheets, and they want to maximize and just capture all the value they can. And you'll get a little too complicated with trying to find, if then scenarios and how you can upsell and track their growth and then capture everything. All right. And so you've got a basic subscription revenue, you've got a volume-based revenue that you can do. But if you keep it simple, your customers will be a lot happier. All right. So the one thing I've noticed, for example, back at when I was in the healthcare IT space, I noticed a lot of healthcare systems, they would be willing to pay more money for a predictable revenue stream. So just call it a flat subscription. They'll pay 10% more as long as there wasn't some sort of variable component where they're worried about a surprise or something unbudgeted at the end of the period. So if you knocked out that variable upside, then they'd be willing to pay more money for predictability and budgeting. So keeping it simple, just a flat subscription was huge in that industry, and they loved it. Right. A lot of us have worked with Microsoft, and it's beyond frustrating where you have to have a consultant with a PhD in Microsoft to understand what you even need to pay. Right. No one wants that. So keeping it simple is very customer centric and it helps keep everybody happy. Another thing I'd point to that goes wrong is if you don't have buy-in in the company, particularly the sales team, right? I've had one where large price increase made me nervous. All the math worked out, everything seemed to point to the right thing, and the price point we're highly confident that was about it. But when it came time to go out to the market and sell at this new price point, we had our first big customer that made me nervous, but the sales guy was fully bought in and he went for it, and we ended up closing deals and it was great. But I can compare that to other companies where you've done a price increase, even a much smaller price increase. And if they just don't have the confidence and the buy-in, then they kind of end up maybe even unintentionally sabotaging it because they see some customers they lose and they just immediately point to, yeah, we got to panic and back off. So you want to be able to react quickly, and you want to keep a close eye on it and watch and see if your sales close rates spike, the close losses spike because you're just out of the market. But it's not always a price issue if it doesn't work. A lot of times, back to the alignment issue, a lot of times you have people selling on an old price discounting structure that's not selling on a value structure, so you don't get the full impact of your price increase because the alignment's missing. So it's not always, so you keep an eye on it, but you have to understand exactly if you're losing more deals, why. It might not always be pricing.
It's maybe an obvious statement, but it really, to me, highlights the importance of making sure the sales team is highly skilled at customer engagement and messaging, period. Because if you're selling on discounting or you're using it as a transaction, more than likely you're going to come up short. But it's a good opportunity for the sales team to really fine tune their value-based selling approach to where maybe even certain customers are happy with the price increase based on the new capabilities.
Absolutely. And that's the funny thing I've seen before too, is in those circumstances, I've seen where the new pricing doesn't really seem to take off. And you might even have some turnover on the team. Then the new people come in, they don't know any better, and they just sell it and it takes off and it's great. Right. So it's just the person was a holdup.
Mhm.
And I've also had some times where it seems that you have to keep an eye because sometimes maybe you miss a little bit and you need to adjust. But you don't want to be in a situation now where a month down or a year down the road, you've got 8 different price points you sold your customers at, and you're bouncing all over and trying to react and catch it all. So you want to make sure that you don't get in that situation where it's all trial and error and all science is kind of thrown out the window.
Mhm. Is there a pricing centric KPI or two that you've either created or among the broader set that you pay particularly close attention to help keep your finger on the pulse of pricing behavior?
So yeah, there are. And so I would actually point you to, if you start with your standard sales pipeline metrics, and you just you can compare it before and after. So you can compare to yourself in history, and you can compare to industry benchmarks, and better yet, if you kind of know where your competitors are landing and what they can do, you should see from this. So for example, the one I keep bringing up, healthcare IT company, if you compare the before and after, they hadn't closed a deal in over a year. This was an enterprise sale, so bigger customers, fewer sales. And then we started closing deals almost every month immediately after we did the pricing, right? So the things I keep an eye on is your time to close. So as you're walking, seeing how fast things progress through the pipeline, things, if they slow down a lot or versus speed up or kind of stay the same, even if it's a price increase and they stay the same, it's still a good thing, right? You just want to watch for a major slowdown. Your conversion rates, and you want to try to understand it. So sometimes there can be other things at play, like lead quality could be an impact, but you want to understand, and just that's where you're going to see it is through your sales pipeline. If things are progressing, if they're closing, how fast they're moving, that's the biggest indicator of if how the pricing is going.
Yeah, yeah, great insight. And then kind of last topic here. So we recruit across several different sectors, including SaaS, but we also serve a lot of manufacturing businesses, business services companies, different business models that aren't necessarily on a subscription-based solution. And we just see a lot more emphasis on strategic pricing in technology companies. But I'm sure that our non-tech friends out there can benefit from a lot of this. So I know you've not spent much time outside of tech, but if you had to guess and offer one or two pieces of advice to non-tech companies, that's the most salient takeaway for how to kind of take a fresh look at their own pricing strategies. What would those be?
I think the main principles still apply across the board. So the good news is it's different in every industry and every company. Every company I've been to, the end result has looked a little different. Maybe the pricing structure has been different, um, but it's but the same principles apply across the board. So that's the good news, right? So I would say even in any industry, you would still try to understand the competitive landscape. You try to see where they land, see how your company stacks up against it, and you really start with the value prop. Why would your customers do business with you instead of a competitor? Right? You have to believe that they'd be a fool to do business with anyone else but you, and why is that? And once you start with that, then everything you can triangulate everything the same way, which is what's the value prop? Can you give them a credible no-brainer? How does that compare and triangulate against your competitors in the market? And then also the other piece I've mentioned is how does that compare to your own cost structure? Because maybe it looks great in the market, but if you're selling it at a loss, then it obviously doesn't work. You got to make sure that your margin makes sense. And once you line up everything, that just kind of becomes your starting point, which is now you're priced right. you can align the rest of your company and the way you structure your costs and the way you do your sales approach to all focus on that value prop that you offer to your customer. Why is it that you're better than your competitors? Start with that message, help them see it, because then your competitors are excited to do business with you. Or sorry, your customers are excited to do business with you because they see that value. They see how they're willing to pay that price because it almost feels free because they're willing to pay it because they see the value they're willing to get. And then everything then lines up from there. So I'd say the principles still apply, even if the end result looks a lot different, or even the structure, the packaging. I've seen somewhere it's a per transaction pricing, it's a flat subscription model, it's a revenue share of the uplift. Kind of like we talked about, these consultants, sometimes they get a piece of the upside. Well, that's the same theory, right? So if you're going to get a lift in revenue, hey, it's free. You don't pay anything until I just get a piece of that uplift. And it ends up being expensive. We see it as expensive because we see it that way. But frankly, the benefit we get still is worth the payment we make. So it's the same kind of theory. So it can take all kinds of different shapes, but it starts with the same principles.
And I think I could probably answer my own last question here. But for companies that are dealing with like a business line leader as the key stakeholder customer, yeah, that you can kind of get them comfortable with why this is good for them and going to make their life a little bit better. But when procurement gets involved, they're a little dispassionate and disconnected from those emotional arguments, and even the analysis of potential upside or the opportunity to grow your businesses together. They're incented to keep costs down, at all costs. So I don't know if you have dealt much with procurement on your SaaS offerings, but if so, any approaches that can help with that conversation?
Actually, yes. So I've dealt with that a lot. So the funny thing is, you're exactly right. Either they don't see the value or they're paid to ignore it. A lot of times you get into a dogfight with everything is going great, the sale's almost ready to close, and then all of a sudden you run up against the procurement guy. A couple pointers on that one. First one is, that's why it's a good idea to start off with a value prop that's believable, right? So if I point to value prop, maybe my pricing and all the math and everything lines up. But if my value prop is something that the customer doesn't truly see, I'm really trying to convince them of something, or maybe it's just not that believable. It becomes not credible. I've had some procurement guys try to sit there and argue with me about the value prop and say, yeah, you're not really delivering that value. So you want to start with something that's as obvious as you can make it, to where you're not arguing about the merit of your value, right? The more universally accepted you can make it, the better.
I
But
would
even when
suspect, real quick, those procurement folks are particularly calibrated to sniff any kind of spin or overreach on a value proposition. So keeping it as believable and consumable as possible, resonates with me.
Absolutely. Yeah. You don't want to spend half your time arguing about the math behind your value prop. You want them to believe it, be on the same page, aligned with you, and then just move straight on to how we can partner together.
Yeah.
But even with that, you're right. They've seen it all. They've sniffed it all out. And so even beyond that, you'll still have issues sometimes. And so when I've gotten to that, sometimes my two main pieces of advice would be, believe in it and stick to the pricing. Right. By the time it gets to the procurement guy, you've got people on the other side of the table who believe it and they want to partner with you. You're that far, you got to still believe in it and be willing to stand up for your pricing and not just go into discounting and be desperate to get a deal. And then the second thing is, I've had a couple times where they've almost killed a deal. And so what I've gone back to is, I've even got back to the deal sponsor on their side, go to their boss, whoever it is, the COO or whoever it is that was excited about the deal. And you've got a relationship built at that point that you're ready to close a deal. And I've even told them, hey, listen, I'm excited to do business, but your guy over here, he's almost ready to ruin the deal. I want to partner, but don't let this guy get in the way. And then they comes back down and they push it through. So those would probably be my two best pieces of advice for how to deal with someone like that.
Yep. Interesting. Well, I want to give Brian a quick shout out. Whenever we do searches, we're always asked, whatever the function is, we really want a business person who happens to have X toolkit, financial, sales and marketing, whatever. And I just appreciate the way Brian talks about enterprise value and pricing. I'm not sure you would guess he was a CFO if you didn't know that context going in. So this is a great lesson, I think, for all of us on how to create value in the private equity backed mid-market, which is focused on enterprise value. as an outcome of your job, not necessarily doing your job without that connection point. So, Brian, thank you. This has been fantastic. I know I'm going to re-listen to this and take some copious notes. And I know our listeners are going to have appreciated it as well. Anything you'd like to offer in closing?
No, just it's been a pleasure. It's been fun doing this. If you ever have any questions, feel free to reach out. Hopefully we do this again sometime.